developers and builders looking in Central Texas amid the slowness in the market and amid all the supply that is present, but everybody sees the writing on the wall. The supply cliff is coming, right? There's going to be a dramatic drop off this year and especially next year in the number of new deliveries of BTR units. So they're gearing up, I think, for that moment. I'm Brad Hunter. Welcome to another episode of the Fireside Chat. Why do we call it a Fireside Chat? There's no fire, there's nothing on the side, but it just felt a little dumb just to call it a chat, but here we are. And we're going to talk about all things related to BTR. We'll talk about rent trends, absorption paces, the executive order, builders, equity, debt, demand, supply. Joining me as last time is Audrey Herrero. She is our in-house BTR market expert. She comes with a fantastic background for doing what we do, given that she used to be the head of BTR at SVN SFR Hub. So she, from the brokerage side, looked at hundreds of sites all around the country. And so really excited to kick off the discussion. What I thought I'd start out with is just a look at what we're hearing from our clients in terms of absorption and pricing trends. And what we're finding is, and I just spoke with one of our clients yesterday, and they said that they're getting a lot of tours, but very few applications. And I thought that that was a really pithy way of explaining what's going on. Also, rent growth is very sluggish. Rent increases on stabilized BTR communities between 1.5 and 2%. And then absorption pace is kind of 4 to 6 a month. Obviously, it depends on the type of product. Can be a little bit higher than that, but they're definitely restrained compared to what they had been. And so I'd like to kick over to you, Audrey, and say, what do you feel like have been the surprises as we've been doing these market studies on BTR communities? What's surprised you?
Yeah, absolutely. And just touching on what you just noticed too in the market and what we're hearing from some of our clients that we're seeing, not much rent growth. We're seeing a little bit lower absorption. It's still just a bit slow on the rental side. I think that's because we are still seeing a lot of supply being delivered into many markets, small and large. And so a lot of these markets are just actively still absorbing. And so you see a little bit of the compressed occupancy rates as well. But we will be moving out of that. It's just, I think we need to get through this, state of having quite a few communities that were still on the books that are being delivered and starting to lease up. So other than that, I think we've been kind of working through that environment for a while now, just seeing those steady returns, steady rents, not much rent growth. But there is a few different shifts that we're kind of seeing in the background. And one of the big ones I want to touch on is how build for rent products we have seen across a few different developers and architects that we've been working with is that build for rent product is now being repurposed into for sale product. So in the past, we always used to see that for sale product was typically larger, still around those 3 to 4 bedroom is the most popular. But we're now seeing this scaling back finish level as well as sizing in product so that the for sale product looks a lot more like the traditional rental product. So we may be looking at sub 2,000 square feet, 3 to 4 bedroom, and then scaling down the finishes a little bit. So it's a little bit more of that attainable entry level product. So I think this is great for the build for rent industry as a whole as we move into the next couple of years because the delta between those two types of products is going to be a lot smaller and so they can be better interchanged, which is always a plus.
Yeah, yeah, and you touched on a couple of things that spurred other thoughts for me. And one of them is that we are seeing that the sort of moderately priced, middle of the road kinds of communities are absorbing faster than the ones that are more at the upper end of the market. And
Absolutely.
so, that's part of positioning, right? It's how we think about what is the optimal positioning of the community. And then
Mhm.
it also kind of touches on what the builders themselves are doing because the builders although they're struggling right now to get sales, they're not discounting much yet for selling to the BTR companies. There's some discounting on inventory and closeouts, but not on full communities. The buyers need to get to a six cap, right? And so, offering at prices that are maybe 5% below retail don't quite get you there. You probably have to
Okay.
be closer to 15% below. And there just aren't very many deals like that are happening right now.
Mhm. And I think that's a trend we're seeing on both the retail side and the rental side is consumers are very price conscious right now. Living costs have really been tight. And so we definitely see that on the rental side is when operators and developers are able to build out their build for rent communities to have some smaller, more affordable units, it actually ends up being so much better from an absorption play because they're able to offer that more attainable rental price in order to enter into their community. So that's something that we've recommended to our clients as well is saying, hey, maybe you should add in that smaller two bedroom that you normally wouldn't build just because it offers that lower rental price and it looks really good compared to the other competition in the market.
Another topic that's definitely generating a lot of interest is the executive order in which the president is trying to limit how much investment that the large institutional investors, however that gets defined, can purchase single family homes. And then, of course, that goes to what Fannie and Freddie are going to be able to do. So the executive order is at the federal level, but the state legislators are getting into the act as well. Now, the good thing about the federal executive order is that it does carve out BTR specifically. So it's going to affect the SFR operators and investors more than BTR. But I mean, there's some concern out there that regardless of whether the EO gets codified or if Georgia or Arizona or other states pass bills, the exit is now in question in the minds of the
Mhm.
Capitol. And, will Fannie Mae be there? But I've had a lot of conversations with folks about this and through conversations with folks on the ULI SFRC council that I'm on, the LPs are still feeling like Fannie Mae is going to be there. And so that's pretty reassuring. But we've got to keep our eye on this. This could be really hazardous for the industry.
Right now with just the unknown as we are seeing and hearing from some of our clients that capital has really put a pause on funding until they find out what's going to happen and see a resolve.
Mhm.
So, it's one more thing right now that capital is kind of getting cold feet on right now. So
Yeah.
we'll just have to wait and see where that ends up.
Right. And on the debt side, things are loosening up a bit, but equity is still holding back. They say, hey, we're ready to invest in BTR development. However, it's got to be a perfect looking deal, right? So I kind of view them as being present but not motivated. No green bananas. They don't want anything that's not entirely ripe and ready to go, right? Which brings us to some of the markets that got hard hit by the oversupply, Texas and Florida. You've done some work in Texas. What have you been seeing there?
Yeah, so Texas, specifically Central Texas, Austin, San Antonio, that I-35 corridor that connects the two. That was one of the first to really be hit hard. And we're now seeing in this past year, a lot of tech firms have pulled out. People are losing their jobs there. And so we have seen a decrease in rents, and that was to be expected with how high they had shot up during 2021, 2022. But what has been surprising is as equity has pulled out of a lot of those primary markets in the past couple of years, we are seeing them emerging and being more interested into coming back into markets like Austin or, for example, San Antonio, where maybe it didn't see as much of an increase in rents, but there's still a lot of good foundational items that looks good for build for rent. We were just on the phone with a large private builder, and they are really focusing their efforts into that central Texas area. So that's a good indication of where these next year or two is going to look. I wouldn't count out the primary markets that have seemed to be too expensive in these past couple of years. I would keep an eye open for those. And I think what we're going to see and what we've seen in many different markets is a move out from the main metro area. So the county with that's going to have that large metro, as in, Austin, Texas, or some of these other large primary markets. We may see a lot of these renters start to move out to get a little bit more space in the surrounding counties. And so we can see that in net migration patterns as well, that's still very much prevalent. So that's something to watch.
Yeah, that's very telling that you have developers and builders looking in Central Texas amid the slowness in the market and amid all the supply that is present, but
Mhm.
everybody sees the writing on the wall. The supply cliff is coming, right? There's going to be a dramatic drop off this year and especially next year in the number of new deliveries of BTR units. So they're gearing up, I think, for that moment. And I think that that private builder you mentioned is looking at raw land deals, figuring, 2 or 3 years down the road, they come to market with lots and homes, and then that's perfect timing. And I think it will be an excellent time to come out with product when very few
Absolutely.
others will.
Yeah, absolutely. And I think that brings us to a really good point. What can developers and operators really be focusing on now? Absolutely, still getting deals in the pipeline. There's still deals that are penciling out there. You just have to know where to look and also know which levers to pull. So, product becomes as crucial as ever. I know we harp on that a ton, but making sure that you have the right product is going to make or break a deal. And that comes down to unit mix too. If you're trying to push too many 2 bedrooms in a market that's really lacking those 3 and 4 bedrooms, then that's something that you can easily adjust and you're going to see the returns on your project be so much better too. So I think that's where these third party reports and the reports that we put out at Hunter Housing Economics become so crucial is in these markets where there's a little less margin on deals because anything can make or break the deal. So that's definitely a conversation that we've heard coming from the client side and seen an, uptake in reports wanting to be done is because they need questions answered or just looking at markets and saying, where should I be focusing my efforts?
It's a well-placed plug for our service too. And you and I have worked together on what we call the optimization studies, where we're looking at what should the unit sizes be, what should the mix be, what about amenities and features and all those kinds of things. And then we can express in financial terms how that affects the return on the investment.
Absolutely. And I think one more thing is management, how you're managing a product and a community. That's really what separates you from a lot of the mom and pop operators out there. And that's what gives build for rent communities such a higher premium is because you have the professional management, you have the 24-hour maintenance. You always have somebody that's going to answer your call. Um, and that is a headwind that our industry as a whole is facing right now with so many
Mhm.
people unable to sell their homes, which such a slow retail for sale market, they're ending up turning them into rental homes. So we have seen quite a big uptake in scattered single family homes that are listed on the market. And so you can look at that as a competitor to the build for rent space. But I think with our experience, we've seen that it's not a huge competition just because the scale of product and the level of experience that you're able to offer the potential renter is so different. So definitely lean into your management style. I will say I've seen a lot of virtual leasing agents when I've called build for rent communities, and that is one of the biggest turnoffs for any potential renter. So just keep that in mind.
Yeah, because when you're a tenant and your refrigerator breaks, you want to know that somebody's going to be very responsive. And that's one of the big advantages that the professional operators have over the individually owned SFR units, because you know that somebody's going to be out there quickly to get it fixed efficiently and with little disruption to your life as a renter. So definitely a big selling point. We can't not acknowledge that things are slow right now. And so, I think about some of the issues that are at play. Obviously, the large amount of supply is the number one issue, but also we know the population growth has slowed. Household formation rates have been extremely strong, but are starting to taper off. Job growth And if you think about, you know, it's the K-shaped economy, right? So certain sectors of the economy are not doing so well, but the AI portion of the economy is massive now, and GDP growth would not be particularly strong right now if not for AI. But that doesn't necessarily generate a lot of jobs, and it's actually taking away some jobs. So it's a very complex soup that we've been cooking here in this economy, and then issues like income growth. What do you think is the number one factor, Audrey, with that kind of whole list of things besides obviously supply?
Yeah, I mean, I think it's such a unique conversation because depending on what market we're talking about, it can look so different just based on the main employment sectors. So if we're looking at a smaller Midwest market, you may see a little bit more blue collar jobs, and those are what's surging right now, and that's still strong. Or you may be looking at Austin, Texas, where it's a huge tech hub, and so
Mhm.
they're really hurting right now on the job side. So I
Mhm.
think it just comes down to really understanding what market you're looking at and understanding the demographics and what's going on at really a deeper level so that you
Mhm.
can understand what sort of product and what sort of community experience your potential build for rent resident is looking for. So it really
Yeah,
depends market by market, but
it's very much local, absolutely. And in fact, that brings into the discussion domestic migration, which is way down. Places like Florida used to get a whole lot more people coming in from New York, New Jersey, Connecticut, Pennsylvania, everything like that. And Texas, from California, people moving out of California to again, the lower tax states attracting people. But a lot of that decline in domestic migration is on the for sale side. And that's because of the lock-in effect for mortgages. People that have a 3.5% mortgage don't want to, even if they can buy a house from a builder at 4.99 with a mortgage rate buy down, that's still a big gap, and it represents a big increase in their monthly payment. And if they're going to buy a used home, then the jump in their mortgage payment is going to be even more. So that's why largely the domestic migration is so low. Renters, I think, are still a bit more mobile, but their migration is lower too. So these are kind of th issues to think about what will be in store for not just domestic migration, but also international migration. And how does national policy impact how many people are coming in from other countries? And that's a big part of population growth historically too. So I mean, if we absorb 518,000 rental units overall, including apartments and everything in 2025, it's likely going to be down to 450,000 absorption per year for the next few years. That's from a conversation I had with the research team at Yardi, and really makes a lot of sense. So all of this kind of boils down to uncertainty about the executive order and the state's treatment of this kind of BTR and SFR ownership by large investors. Um, and so, you touched on some of the things that the developers can do to handle uncertainty, make sure that you're positioning thoughtfully, thinking through the product and features and amenities very carefully. Um, so any kind of last thoughts as we wind up? Or
yeah, I think and I don't mean for this to sound like a plug, but it does come back to making sure that your due diligence is locked in and sound, exploring every possible avenue and making sure that you're seeing every pain point or challenge that you may run into in the build front space because things can change in your development period of 1 or 2 years. So
Mhm.
making sure that you know exactly what you may face in those couple of years is so crucial. And that's just something that we're able to uncover in these reports. And we see it time and time again in client presentations is clients are surprised to see certain things that we're picking up on or certain trends in the data that we're able to expose. And they're just so happy and so grateful because they weren't expecting that and that wasn't going to be something that they were going to plan for. So with
Mhm.
more difficult market, you are definitely having tighter returns, and that's at the end of the day less room for error. So your due diligence just becomes so much more crucial.
Yeah, and you do have to have a vision towards the future, right? And we've talked a lot about how that cliff of supply is coming and there's going to be very few deliveries, and I feel confident will support rent growth starting in
Absolutely.
2027, possibly a little bit in 2026, maybe in the second half, but 27, 28 is going to be tremendously stronger. And remember too, renter incomes are growing a lot faster. Don't go by the economists out there that are talking about how income growth is 1 or 2%. Renters are seeing their income grow at a much faster annual rate than that. And that's because typically the group skews younger and they're growing in their careers or they're getting promoted or starting their own companies, what have you. And so they're seeing a lot of times double digit annual growth in their incomes, and rent to income ratios are still in the 20, 28, 29% range, nowhere near the 30 to 33, 34% range that starts to become a problem. So there is room for rent increases to come through, especially in the upper levels of the rental market. And I think that the people that are outgrowing apartments are going to look at BTR. And there was a long history of pent-up demand in BTR, and I think we're going to be back to a period of pent-up demand by sometime next year.
Hmm.
So with
Well,
that,
that's
yeah,
something that we've been hearing from clients as well, is demand is still super strong. That's still a great foundational item of build for rent communities, is people are still out there looking for a great place to live, and it's going to be a rental.
yeah, that's right. And with President Trump saying we don't want to bring home prices down, we want to bring home prices higher, that's going to push more people into renting. And so, again, the writing's on the wall. Things are slow right now, but certainly going to get a lot better. So,
Absolutely.
thank you for joining us. It's always a pleasure to have a conversation about all of this, and reach out to us if you have any questions or concerns. Thank you.
Absolutely. Thank you guys.